Welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, July 30th, 2025, we are taking a comprehensive look at the GBPUSD currency pair, which is experiencing significant volatility. We will examine the interplay of current events and their impact on price action across different timeframes. Our analysis will cover long-term trends, recent reversals, crucial support and resistance zones, and key price levels for your trading decisions. First, let's get a broad overview of the daily chart, showing all available data from March 2024 up to the close of July 29th, 2025. As you can see, GBPUSD has generally been in an upward trend over this period, establishing higher highs and higher lows. However, the most recent price action, particularly in July 2025, shows a notable shift, indicating a potential reversal of this established trend. This recent movement is heavily influenced by the latest macroeconomic developments, which we will discuss next. Turning our attention to the news, recent reports paint a clear picture of prevailing bearish sentiment for GBPUSD. FX Street indicates that pound sterling to US dollar has dropped to a fresh two-month low, falling below the critical 1.3300 level. This downturn is further amplified by MyTrade's report that the pair is extending losses as the Federal Reserve trims its rate cut expectations, reinforcing dollar strength. Economies.com highlights that the price has confirmed breaking the critical support at 1.3365, a significant technical development. The broader market mood is described as cautious, especially among dollar traders, as they await a potentially pivotal Federal Reserve decision this Wednesday regarding the likelihood of a September interest rate cut. While the US dollar experienced a slight dip, its momentum quickly stalled, holding a softer tone in narrow ranges against G10 currencies. Meanwhile, UK stocks have shown varied performance, closing lower on Wednesday due to losses in specific sectors, and the FTSE 100 index remained flat. Action Forex suggests that the intraday bias is now firmly on the downside, projecting a potential target of 1.3163 if the current momentum continues. This news implies that the bearish pressure intensified on July 30th, building on the weakness observed at the end of July 29's trading. The current trading rate around 1.32423, as per TradingView, falls squarely within the lower range mentioned in these news snippets. Therefore, the market is closely watching how these fundamental factors will continue to influence GBPUSD's price action. The combination of a hawkish Fed outlook and struggling UK market sectors is creating a challenging environment for the pound. Now, let's analyze the daily chart, focusing on the recent price action from May 2025 through July 29, 2025. After reaching a high of approximately 1.3724 on June 26, 2025, GBPUSD has experienced a significant and sharp decline. This steep bearish momentum in July is clearly visible through a series of strong red candles, signaling aggressive selling pressure. The close on July 29, 2025, was at 1.33528, which, while above 1.3300, saw an intraday low of 1.33069, confirming the news that it indeed dipped below 1.3300. The break below 1.3365, identified in the news as a critical support, aligns perfectly with the sharp downward move. This level, which previously acted as support in April and May, has now decisively turned into resistance. The high volume accompanying these downward moves indicates strong conviction from sellers. We can observe significant resistance around the 1.3400 to 1.3450 area, which was tested and failed multiple times in late July. The current price is hovering around the 1.3350 level, indicating a pivotal battle between buyers and sellers. A sustained break and close below 1.3300 on the daily chart would confirm further bearish continuation. The overall upward trend from March 2024 is now under severe threat from this recent sharp reversal. If the price cannot quickly reclaim levels above 1.3365, the short-term outlook remains distinctly bearish. This recent breakdown could easily lead to a test of lower support zones. Therefore, the candles of late July are crucial in shaping the short to medium-term direction of the pair. The sheer magnitude of the July drop underscores the market's response to the evolving fundamental landscape. Now, let's zoom in on the 15-minute chart to understand the intraday price action leading up to today, focusing on July 28th and 29th, 2025. Please note that while this data is the most recent available, ending on July 29th, it precedes today's full trading session, July 30th, where some of the news reports originated. On July 28th, the price initially showed consolidation, fluctuating within a tight range, before starting a more pronounced decline. We can see a series of lower highs and lower lows forming on July 29th, indicating clear bearish control in the intraday timeframe. The heaviest selling pressure occurred during morning and afternoon trading on July 29th, consistent with the daily chart's large red candle. The low of the day on July 29th, around 1.33069, is clearly visible on this granular chart, showing the immediate rejection from that level towards the end of the day. This rejection, although minimal, suggests some buying interest around the 1.3300 psychological support at the close of July 29th. However, the news for July 30th indicates that this temporary hold was short-lived, with prices again facing significant pressure. Intraday traders should watch for continued breaks of minor support levels, as these will confirm the broader bearish sentiment. Conversely, any strong buying volume pushing prices back above 1.3350 on this time frame would signal a potential short-term reversal. The 15-minute chart helps us identify rapid shifts in momentum and precise entry/exit points during volatile periods. Observing the sequence of candles, one can infer the immediate supply and demand dynamics, crucial for day trading strategies. Transitioning to the 1-hour chart, it's important to remember that this dataset covers an earlier period, specifically from July 10th to July 15th, 2025. Therefore, it does not reflect the most recent news or price action of late July. However, it still provides valuable insights into how intraday trends can develop and what to look for. During this period, GBPUSD also showed a general downtrend, moving from around 1.36 to approximately 1.34. This demonstrates that, even in mid-July, prior to the most recent sharp drops, intraday weakness was present. Identifying patterns like consecutive bearish hourly candles or failure to hold above moving averages on this time frame can give early signals of broader shifts. It teaches us to watch for sharp, high-volume drops that can lead to significant daily losses, a scenario playing out even more aggressively in the present. The volatility seen here, with swings of several pips within hours, is typical for GBPUSD, highlighting the importance of managing risk. Returning to the daily chart for our future outlook, the short-term prognosis for GBPUSD leans heavily bearish, especially considering the current news. The immediate key price level to watch is 1.3300. If it breaks and holds below, it would solidify the bearish momentum. The news suggests this level is already being tested on July 30th, indicating strong selling pressure. Below 1.3300, the next significant support, as projected by Action Forex, is around 1.3163. This level would represent a 100% projection of an earlier move and would be a critical psychological and technical test for the pair. A sustained move below 1.3163 could indicate a more profound reversal of the long-term uptrend observed since March 2024. For reasons to be bearish, the primary driver is the Federal Reserve's stance on interest rates, with expectations for cuts being trimmed. This reinforces US dollar strength, naturally pushing GBPUSD lower. Coupled with varied performance and weakness in some UK stock sectors, the fundamental backdrop for the pound is challenging. Conversely, a bullish reversal would require a swift reclamation of former support levels. If GBPUSD manages to close decisively back above 1.3365, it could signal a false breakdown, potentially leading to a short-term rebound. However, given the current news, the likelihood of this immediate bullish scenario is relatively low, perhaps 20 to 30%. A A significant bullish move would likely need unexpected dovish remarks from the Fed or stronger than expected UK economic data. Long term, if the price can eventually find strong support above 1.3163 and consolidate, it could set the stage for a renewed upward trend later in the year. Traders should monitor not just price, but also volume, as high volume on a break confirms conviction, while low volume could signal a trap. In summary, GBPUSD is facing strong bearish pressure on July 30, 2025, driven primarily by a hawkish Federal Reserve outlook and a break of key technical support levels. The critical price levels to watch in the short term are 1.3300 and 1.3365, both of which have been challenged or broken, turning them into significant resistance areas. A confirmed break below 1.3300 opens the path towards the 1.3163 downside target, which has a high likelihood of occurring if current market sentiment persists. We estimate a 70 to 80% likelihood of continued short-term bearishness, particularly if the Fed's stance on Wednesday reinforces dollar strength. Conditions that would reinforce this likelihood include further weak UK economic data or persistent risk-off sentiment in global markets. For a bullish reversal, the price needs to decisively reclaim and hold above 1.3365, indicating a rejection of the recent breakdown. Important upcoming events to look for include the detailed Federal Reserve statements this Wednesday, as well as decisions from the Bank of Canada and Bank of Japan. Monitoring these central bank announcements is paramount, as they can trigger significant shifts in currency pair dynamics. Always remember to incorporate robust risk management into your trading strategy, especially during periods of high volatility. Thank you for watching this in-depth analysis on Explain the Charts, and we wish you successful trading.